Okay, so we are recording and we've got the chapter 3 notes that we're going to start on. Okay, just one quick announcement. I talked about it a minute ago. We have 35 people in this class, a lot of student athletes. The platform, because this one is not equipped for it's people all I did was podcast in the room. So it's completely useless. For the people online can't hear me unless I'm standing next to the desk, which I, as you can tell, don't like to do. So we may move to the UC. I hope that's convenient for you guys. But I will let you know via email, but I'll also post something on the door here. So if you come to this class by mistake, you guys will know about it, okay? All right. So we're jumping into chapter 3 here. These are the objectives of the chapter. And then we have the class goals. Now, this handout will probably be used for 2 classes, depending on how quickly or slow we go. And so we're jumping over to accrual versus cash basis. Somebody just came in and they didn't have a copy. Okay, so when we think about cash basis, that's kind of how we operate. How with having a job and having to do your own taxes. If you're looking at your pay, then you kind of operate on the cash basis. If you didn't get paid in that year, even though they told you they were gonna pay you, do you pay taxes? Right? You don't pay any taxes, you get paid when you are. So what you worked in December, and you get paid in January, that would count towards the next year. Some small businesses run on that, but if you are a large public business, you cannot use cash basis. All right, basically, with cash basis, you record a transaction when you have a cash in hand or when you pay it out. Now, the timing is different because we look at the laws and we say, okay, we're going to use what's called accrual basis. And accrual basis means that when you have the right to revenue, that's when you record it. So for example, if we were a business and we worked December and we were going to bill on December 30th and it was supposed to be paid in January, we would still be able to record our revenue through accounts payable, or excuse me, accounts receivable, right? So we can record things based on accrual and deferral. So revenue recognition with cash basis occurs when the cash is received. Expense recognition, when the expense is paid. Now, what does that already sound different than what we did just on this practice or in the past? What did we do in one of these questions that might be similar to this? Right, we prepaid it, right? With cash basis, you don't get a prepay. When you pay it, that's when you record the expense. So in that other question, we were only allowed to expense $200 of it. But if you're on the cash basis, you would expense all $600. Okay, credit accounts. There are none. Now, of course, some cash basis customers may take credit, but typically they're not operating with credit accounts. They don't have accounts payable and accounts receivable. They're usually getting money from a processing box, where you're running your credit cards, something like that. And that's considered relatively immediate. Taxation based on cash received versus cash paid. How is the accuracy of the information? It's either going to over or under state company value by excluding revenues and expenses. Cash basis accounting has no rules. And usually this is used by small businesses. Now, with accrual basis, that's what we're learning to do. And we're learning to look at the timing and say, do we have a right to collect this amount? Are we obligated to pay this amount? And so we are going to use accruals to hopefully make a more informative financial statement. So for accrual basis, it's when the revenue is earned. Or expense, it's when the expense is incurred. So we talked about that question, and we were only allowed to expense part of it because we had 2 more months of prepaid. Credit accounts, accounts payable, and accounts receivable. You may also see trade payables or receivables. Note that that's the same thing. They're just telling you that's their specific industry. So for tax, it's based on accrued revenue and expenses. So we as accounting see this accuracy as better representing the economic performance of the company. Keep in mind, we do not say that we track economic. And what are the rules? Well, in the United States, you have US GAAP, which is just, we call GAAP. And internationally, IFRS. And that's International Financial Reporting Standards. Now, keep in mind that specific countries usually will have their own GAAP unless they've adopted the International Financial Reporting Standards. I think the US will ever go there because essentially it would take the control of accounting away from Congress if they were to use the IFRS. And then what are these companies used by? Public companies and companies slash other with public debt. So cities and towns typically don't use US GAAP. But if they decide to do a public bond or some type of funding like that, that's going to be available to everybody, then they have to produce GAAP financial statements from there going forward, and they must put it into their prospectus. Governmental accounting is very different from the financial accounting that we're seeing here, so these rules don't apply to government entities. Although they may be subject to them if they decide to go with public debt. And then usually they produce two types of financial statements. There are a lot of companies out there that'll produce financial statements under GAAP, but then they'll also have to produce financial statements for regulators. So like the banking and insurance industry have to produce multiple different types of financial statements for the states that they're in. Okay. Any questions between cash basis and accrual basis? Okay, so now accruals versus deferrals. And I probably should have given you a little bit more room here, but you can kind of put this in at the bottom there. We're not gonna be doing too much with this part of it. I'll give you a second to let you get this little box in if you want to. Okay, so let's talk about deferral. And what do they mean? So when I use a deferral, what does it do for our accounting period? And it pushes recognition in the financial statements to the future. For an accrual, it accelerates recognition into the current period. Okay, and the next part, cash flow pattern related to revenue. And so payment Payment comes before goods or services are transferred. With an accrual, the payment can be made after goods or services transferred. Cash flow patterns for expenses. Cash goes out before related revenue is earned. In this case with accrual, cash goes out after related revenue is earned. What is the effect of a deferral? It increases liabilities. Or an accrual, it increases assets. When you are dealing with expenses and you defer them, it increases assets. And for accrual, it increases liabilities. So here we have the basic, go ahead. Sure. Short. So these are the basic accrual accounts. We are familiar with accounts payable. We're familiar with accounts receivable. What is an accrued liability? Typically, this is unearned revenue. And that's when a customer pays in advance for goods or services be delivered in the future. All right, and when I say pays, I mean cash, right? So if you buy a subscription, you accept that subscription. Until the company delivers that to you, then that's a liability for the company. This defers revenue of recognition into the future. Prepaid expenses defers recognition into the future. We have expense. This will be of And you say, well, how does deferred revenue kind of get put on both sides? It really depends on the part that you're looking for. So not only are you getting it, you're accruing a liability, but you're also recognizing the revenue. It really depends on the perspective, whether or not you're the seller or the buyer. Okay, here's some practice for you. I'll give you guys about 2 minutes. And we'll go over it. Other accrued liability, that's typically a big one. Salaries and wages payable. Just thought about that one. Okay, so updates made to the account balances at the end of each accounting period. So this would be what this chapter is about. We're going to be doing adjusting or adjustments to the financial statements. The rule that requires revenues to be recognized in the period when earned. Revenue recognition principle, E. A transaction in which the exchange of dollars comes before the action. So that would be a deferral. The rule that requires both earnings and the cost of earnings being the expense on the same statement in each accounting period would be the matching principle. And a transaction in which the action comes before the exchange of cash would be a accrual. Any questions? Let's move on to practice 2. Give you guys about 3 minutes to go through that. Keep in mind here that some of these are used more than once. Okay, so let's go ahead and start. So I agree, this one's a little confusing. That's why you gotta make sure that if you don't understand accruals and deferred, you gotta look through them. So this one is an end of period adjustment to recognize office supplies used during a period. So in this case, we bought some office supplies and we're checking what we have left, reporting an expense in the first part, and then kind of deferring the other expense. So this is D, deferred expense. An end of period adjustment to recognize employee salaries earned but unpaid. So this would be B. We just kind of remembered that one in my head. An end of period adjustment to recognize depreciation on certain long-term assets. D. An end of period adjustment to recognize prepaid insurance used up during a period. D. An end of period adjustment to recognize prepaid rent used up during the period. So those are all very similar. Number 6 is an end of period adjustment to recognize interest costs incurred but unpaid. So this would be B. You have to accrue that expense. 7, an end of period adjustment to recognize earnings related to work done but not yet filled. This would be accrued revenue. And an end of period adjustment to recognize the amount of unearned revenue as earned at the end of the period. That would be C. Okay, the next problem is a long demonstration problem that I'm going to walk through. And so we'll start that on Thursday. And y'all are free to go for today. Thank you.